Meantime, the Fed minutes out today reflecting division, a little bit, over the direction of rates. A slim majority of Fed governors expecting 2 more cuts this year, but the central bank overall currently dealing with a dearth of data. Dearth?
Dearth.
Dearth Vader?
Darth?
Thanks to the government shutdown.
I mean, seriously?
The September jobs report.
Don't give me the daggers.
It's dearth.
Yes, it is.
That's it.
Darth is from the movie.
Easy, Ludwig, or whatever you said earlier. It's like my 40th hour of TV this week, all right?
Around.
Ben Emons, thank you for coming on the program. Turn the prompter off. Let's have a good time. Ben, anything in the Fed minutes that makes you think about, change the way you think about these markets?
Well, you actually said it, Brian. There's a slim majority. So there's a group there that wanted to keep rates on hold, even voting for it to make the case. I thought that was notable. That wasn't, I think, exactly out there the last time when we had the statement or in the press conference. You know, a little tick up in the 10-year yield that's sitting right at the 550-day moving average, and kind of watching that, because if this Fed turns a bit more cautious, either because they don't have a dearth of data, right?
Thanks.
or there's just this uncertainty.
The Dutch guy's making fun of my English. I love it. You know, how about this? Words I've never used before. The amazing thing about the bond market is, and I've never started a sentence with that, to quote Guy Adami, but I will say that the 10-year yield hasn't done anything for about a year and a half. It's unbelievable.
It's sideways.
Basically exactly where it was like 18 months ago. Why?
I guess it's more like in trading, as you say, in a wedge, right? Lower highs, higher lows, waiting for some kind of a breakout that we really get confirmation either this is going to be a big burst of next inflation, or we're going to go the other way. We're going to go down south with the economy. That's why I think it's sideways, with a Fed that ratcheted up high rates initially, but then went very careful with rate cuts, and no surprise from the Fed really in between. I think that explains it mostly.
All right, so let's go to Japan for a second, because the yen has been weakening at an alarming clip over the last couple of weeks for a myriad of different reasons, and JGB's yields have been going higher. So there's some relationship problem there that at some point makes its way into our bond market and into our equity market. Speak to that.
Yeah, it remains that issue, guys. It's like the 40-year JGB yield was kind of sort of in the no man's land. It does have correlation with our 30-year. And if you take our 30-year and you take the UK and Australia and all the others, it's kind of an unrelenting trend, just keep trending higher with this JGB market being under pressure because the Bank of Japan has to raise rates because inflation is too high. But we're getting a different political climate now that says maybe you should not hike rates here because, not good for the economy. That's, I think, the tension in the yen currently, and that's why yields go higher.
Let's talk about the Fed's balance sheet. How do you think this plays out?
So the last time I was on, we talked with Steve about, we thought that maybe they would stop the QT, the quantitative tightening program. Mm-hmm. Interesting, in his minutes, they just want to continue with that. But we are at a level of reserves that's, I think, a critical level, just below $3 trillion. Silicon Valley Bank crisis, when that happened, there was sort of the same level of reserves at that time. So there's something about this tightening in the system that's building that could affect the banking system if you have too low reserves. So I do think they're getting to a level of reserves where they're going to have to start really thinking about putting an end to that program.
Jerome Powell has a couple meetings left. We know he's, lame duck for the most part. Whoever comes in, we know they're going to be super dovish about rates. Will the market care? Will that help the stock market?
I think at the margin it would be, because if you have this, what you saw in a minute say, this caution that becomes, say, more hawkish tone, that would be not good for the stock market. So I think leaning more dovish overall probably is at the margin. But it's about the economy, ultimately, right? It's like, is that the right direction here to drive the economy higher? If we're getting faster rate cuts, I think yields are going to go again higher from here, reflecting that you're pushing a lot of stimulus back into the economy with the stock market at record highs.